So, good afternoon. My name is Peter Praet. I am a former executive board member of the ECB. I have the pleasure to chair this meeting, which basically deals with central bank interventions in sovereign debt markets. I had the great pleasure to give the floor to Ricardo Reis. He's going to present this paper in 20 minutes, and that leaves us 10 minutes for discussion. Then we will have 3 other papers that you have seen in the program, but it means, Ricardo, that we have to stick to half an hour per presentation, including the Q&A, of course. So I will be very watchful, and I give you the floor immediately, so we don't waste time.
Okay, thank you so much. Please just confirm that you see my slides. You do?
Yes.
Yeah. Okay,
perfect.
Terrific. Great. Well, thank you very much for having me here. This paper is really about, if you want, the starting point is 2 famous French economists. So it's not a joke about a bar, but there's 2 famous French economists. One was Olivier Blanchard, or is Olivier Blanchard, who had an extremely influential presidential address, where he noted that R, the interest rate on public debt, has been below the growth of the economy, not just for the US, something we had known for a very long time, but also, especially in the last 20 years, R has been below G for most Western economies, and the gap between R and G has increased. And you wonder what implications it would have for the public debt. Now, a different French economist, Thomas Piketty, a few years ago, of course, wrote a whole book on how R is bigger than G. But of course, Thomas' R was a different R. His R is what I'm going to call M, the marginal product of capital. And indeed, M has been above G, consistently above G, maybe even larger now than it was before. So I want to ask, what happens to our thinking about public debt when R is less than G, meaning the interest on the debt is less than the growth rate, but the return on private investments in the economy, M, the growth rate of private wealth, is above G. Now, let me start with pure debt arithmetics to get to to get to immediate implications of this without doing any model of behavior, just through arithmetics. The change in the debt, that is the deficit, is equal, of course, to the total spending, S, which here I divide and multiply by B for reasons that will be obvious, plus the return to the debt holders, where R note is an endogenous object. It's not just the promised interest rate, but reflects also changes in the value of the debt, as long as we have more than just instantaneous short-term debt, which of course we do in reality, okay? So primary deficit plus return to bondholders equals the total deficit. Now, that's just an accounting identity, and it's one that's extremely general, precisely because I wrote R as a return rather than a promised yield, and S is just total amount of spending, no matter what that is. Now, in a balanced growth path, that is when the growth rate of the debt tends to the growth rate of the economy, G, and I'm going to keep throughout this case because I don't want to think about cases where either the debt becomes an infinite percentage of GDP, which, while theoretically you can conjure cases where that's the case, that's not very interesting, nor cases where the debt becomes negligible. In the case in which the debt ends up growing at the rate of GDP, then it is an immediate implication of this equation that in that steady state, B is equal to S divided by G minus R, or B is 0. Both are solutions. Those are the 2 solutions to this equation in that case. This immediately shows you the relevance of the G minus R. The relevance of it is that when the interest on the debt becomes lower than the growth of the economy, that means that you can now sustain a positive amount of debt with a positive amount of spending forever. You can now sustain persistent spending forever. When G and R switch sign, what you change is whether you need a permanent surplus to needing now a permanent deficit. That is not to say that you need an unbounded deficit. And it's not unbounded for 2 reasons. First, even if we start with B being a current, say for the US, 130% of GDP, and a G minus R at a generous 2%, that means that you can have a 2.5% primary deficit forever. So we're not talking about 50% or infinity, just 2.5%, which is, by the way, less than many of the forecasts. Moreover, note that you have to say, but what if the solution is instead that the market value of the debt goes to 0? We have a run on the debt. We have a sovereign default crisis, which is equally a solution to this equation. To answer which case we're in, we need to really endogenize what the G minus R is, because as it changes, this S changes a lot. And we need to figure out what the switching limit is, which I'm going to call cap S, at which 0 becomes a solution to this equation. So here's how I'm going to do it. I'm going to do this first by doing a little bit more of that arithmetics. Now, if you start from this differential equation, and you integrate it forward using R as your discount factor, which is something that you would very commonly do in your graduate economics or macroeconomics class, you end up with a bad mathematical object. And what do I mean by that? You end up with this object that because R is less than G, this goes to plus infinity. That has led some people wrongly to say, aha, there is no government budget constraint when R is less than G because you have plus infinity here. That means there's no limit on the debt. That is just mathematically incorrect because, of course, this other term, the present value of spending or surpluses, is also going to minus infinity, and thus this limit is poorly defined. It's just not a well-defined mathematical limit. So this is just wrong to say that just because R is less than G, and thus you have a potential bubble, there's no limit on the debt. Rather, there is a limit on the debt. Correct mathematics is to use any discount rate D that only has a property that its lim sup, the limit of the supremum of the subsequence is bigger than the growth of the economy, because then you don't encounter these infinities and you can write the budget constraint in this way. Now, this is true for any arbitrary D, any discount rate. The question is, what should D be? At least this way, you're not doing wrong mathematics, but you haven't done any economics yet. You have to now discuss what the right D would be. What I propose in this paper is that we use as discount rate the marginal product of capital, Piketty's R if you want. Why? Because then this first term is indeed a very familiar and well understood term. It is the present value of primary surpluses using as a discount rate the return on private assets in the economy. That return is always a valid stochastic discount factor. If you want to engage in arbitrage pricing, it is always the case that insofar as the marginal holder of the debt could invest it in the capital of the economy, this is the one that would show up in his or her optimality conditions in choosing whether to hold the claim on future surpluses. And moreover, M bigger than G, again, D bigger than G being the key mathematical condition that is needed, and here it's guaranteed. Why? Because it's a transversality condition or dynamic efficiency condition. More interesting is that not only we have this first term, a familiar term, I like to call it the IMF term, the term IMF economists spend a lot of time on. What if I do austerity and lower S? Oh boy, but that may change M in a way that may be defeating or not. What can structural reforms? Nothing but a way to change the M relative to G, and so being able to increase this term. Essentially, this is what a lot of discussion on debt sustainability are all about. But now that R is less than G, we have, or better, R is less than M as well, we have another term. And that is the interesting term. I'm going to call it a debt revenue term. What is this? It is a present value, just as the previous one, but it's a present value now of this product. The product of the difference between M and R. If you think about debt as a bubble, this will be a bubble premium. If you think about debt as giving you some convenience, this is a convenience yield. More, if you're a monetary economist, you may recognize this from the old analysis by Miguel Sidrowski, where the only debt government liability was M, the money supply. And because that paid zero interest, then the M minus R was nothing but the nominal interest rate. And I times M is, of course, the term we all learn is the senior. It just shows up in the government budget constraint, okay? But insight here is when it's not just money that's this dominated bubble asset that people hold, but rather the whole of the government debt that pays you an R less than M, you now have a seniorage, a debt revenue, a convenience, a bubble revenue term. And how large is that? Well, if B is 130% GDP and M minus R is 2%, we're talking about something like 2.5% GDP, which is as large as some of the primary surpluses that we may potentially forecast, or even the spendings that are forecasted by things like the CBO or the European Union. So now we have a term that's as big as the IMF study term that we economists can study, that we economists should study, and that is going to have trade-offs as well, in that, again, different policies are going to trade off this term versus these other terms, and that we can now understand, and that makes sense. It's finite, and that's the first and perhaps the most important point of this paper is, let's study this debt revenue term. Second point of the paper is, let me study it, and how I'm going to study it is, I'm going to write a model that generates this M bigger than G bigger than R, and think about how does more or less spending affect in equilibrium these terms, including this tilting point at which the debt, we have a crisis, okay? And so I'm going to offer a model that endogenizes M, R, and G. and this is my second contribution to this presentation if you want, but even if you don't, but I put here a lot of references of papers that just in the last few months have gotten excited about this term and have started writing different models of this term, as well as of some papers that have started trying to measure the size of this term. And is it really how potentially large it is, how persistent it is, how large in the present value sense, how much does it relax budget condition now? But I'm going to give you in this paper, second contribution is going to be a particular model of this. And that model is going to be a model of misallocation, a model where the reason why M is bigger than G, the bigger than R, is because of inefficiencies in private capital markets. Let me briefly tell you, the model is actually quite simple, even if the notation here betrays it. Start with a neoclassical growth model. Firm as in, say, Paul Romer's PhD thesis. But now, imagine we have two types of heterogeneity. First, there is going to be exact capital types, Q between 0 and 1, such that if you're the high quality type, so you're Peter, you're a high quality guy, you get M, the marginal product of capital. Me, I'm a lower capital guy, I'm a Q a half, I only get half of what he gets, okay? So that's the first, and we have a whole distribution if you want of that. Secondly, Peter not only is on average better than me, more productive, but also he faces no depreciation risk as being the high quality guy, whereas me, my investment may come with some risk, some risky returns. I model this as a depreciation risk in terms of a delta function that is higher is the delta, the lower is my Q, okay? In a simpler case, you may think about, again, Peter, high quality type, the Kiyotaki-Moore style credit market friction. And that is that even though I would love to lend to Peter because he's just higher capital quality and he'll get a higher return, I can only lend to him an amount that is bounded above by a fraction gamma of the returns that he gets. Why? Because the standard Kiyotaki-Moore financial frictions that if Peter exceeded this leverage ratio, he would run away with that and never repay me. Okay, so gamma is the key variable here. And I'm going to focus on balanced growth paths where R is less than G, less than M. Now, why is M bigger than R by G in this economy? If there was no credit frictions, the problem in this economy is very simple. I give all my money to Peter, he invests in high quality capital because we interact in a competitive market. He gives me the returns from that. He earns his returns. AK technology, nothing to see here. But with a gamma less than 1, now on the one hand, I would like to lend to Peter, but I can't. There's a constraint on that. Given that, and given that I know I can be the very productive guy in the future, I will be the Peter of tomorrow. I have a demand for public debt as a store of value, as liquidity. And that means that there's going to be a gap between minus and R, a convenience yield, a premium, because I want to use the public debt to save and can use it for so. Second, because I have to invest in risky capital, unlike giving it to Peter, who's very safe, public debt is also going to be a buffer, gives me a safe return, gives me a buffer that I appreciate in order to diversify some of the risk, and the gap by minus R is driven by the risk of it, okay? What is the equilibrium in this economy? The equilibrium in this economy, let me just show you the proposition, is the following. So there's an equilibrium in this economy, there's some simple conditions, which I refer to the paper to see, but let me describe to you what happens now if there's more spending. I already told you my first goal. I generate an economy where M is bigger than G, the bigger than R. Second goal, what happens if spending increases? Well, if there's going to be more spending, there must be a bigger debt revenue term. Thus, it must be that the bubble premium is higher. How is the bubble premium higher achieved? Well, it must be that the public debt is providing more of those services. How is that? Well, in equilibrium, it must be that the public debt is scarcer. There's less public debt providing those services. Okay? But if the public debt is now lower, that means that now there's less of an ability for me to transfer wealth into the future, and therefore inequality increases. Peter's getting all his M, and I'm getting less of a return. More importantly, as more spending must come with this lower debt in equilibrium or value of the debt, there is a fiscal capacity cap S. If the spending exceeds this S, then there is no equilibrium with positive holdings of debt. The only equilibrium is when the value of the debt jumps to zero. More important property is this one. The more financially developed an economy is, the lower the fiscal capacity. Now, this is not an empirical prediction. This is a ceteris paribus prediction. But it points to the key prediction that I'm trying to highlight in this model. If you have a very developed private credit market, then the private credit market supplies what people want. They don't need to demand as much public debt to give them the safety and liquidity that they want. There's a competition between private and public markets here, private and public debt markets here. Okay? And the less developed is the private market, the more demand is for the safety and liquidity of the public debt market, and the bigger the debt revenue term. Okay. This was done in that simple example where there was a jump in the debt. One can do this with different fiscal policy rules and different neoclassical production functions, but I will, given the interest of time and to use my last 4 minutes, I'm instead going to go to the third type of predictions that I said. M bigger than R and G was the first. Second is what happens if there's more spending. Third is how do different policies affect these fiscal limits and others. And for that, I'm going to ask, I want to do 4 things in 4 minutes, which from a very easy one to a slightly more surprising one. What happens if the government forces people to hold more of its debt? Well, then what does it mean to force it? I force you to hold the debt, even though it pays a well below market rate. Here I set it to 0 in the model. Well, unsurprisingly, that increases the fiscal capacity and space of the government. Why? Because now you have a debt revenue term that's driven by a coercion, a repression term. Okay? It's not voluntary, it's by repression. So unsurprisingly, that increases fiscal capacity. Second, and only slightly more surprising, what happens if I have inflation? Well, anticipated inflation makes no difference. Why? Because in this economy, insofar as we're talking about long-term debt and homogeneities are now first order, then here, to first approximation, that just reflects it in the higher inflation inflation premium of the bond. More interesting is if you have more volatile debt. Volatile inflation, allows you to inflate away the debt, surprise bondholders. But because it increases the inflation risk premium, it makes the public debt less safe. It thus provides less safety premium, less convenient yield, less debt revenue term. In this economy, there's no conflict between price stability and fiscal policy and debt sustainability. Why? Price stability is what keeps inflation risk premium lower, increases debt revenue terms, and thus maximizes fiscal capacity. Third and more interesting, what if I take money from Peter and give it to me, the high quality guy to the low quality guy? Well, that turns out to lower fiscal capacity. Why? Because when we do that and give it to me, what do I want to do? I want to now save more and more and try to give as much as I can to Peter in order to benefit from his high returns. In other words, that redistribution encourages the function of private markets, outcompetes for public debt, and therefore reduces the debt revenue term of the public debt. There is an interesting conflict here. A policymaker that wants to redistribute ends up lowering the fiscal capacity of a policymaker that wants to spend more, because redistribution lowers the capacity by lowering the debt revenue term. One of the surprising things about thinking about the debt revenue term as opposed to the IMF term. And fourth, and equally surprising, if we have an income tax, which here is all capital income, there's only capital income in this economy. If you have an income tax, that can pay for itself in this economy. Why? Because when you cut the income tax, here, the reason why it can pay for itself is because but a cut in income tax increases the ability of Peter to borrow, stimulates private debt markets, and thus, by stimulating private debt markets, leads to an increase in real activity that ends up relaxing the government budget constraint. This says that in this effect here, where the tax cuts for themselves, there's now an effect not on what happened to investment, as usually is done in the tax cuts paying for themselves literature, but on the effect that it has on misallocation, on the functioning of private and public credit markets. 30 seconds to conclude. Debt is at historically high levels. This is from the IMF Fiscal Monitor back in October. We basically have the highest debt ever. we certainly as economists have to start thinking about debt sustainability again. And thus this session, I think this is the one-page motivation for this entire session, and us thinking about debt sustainability. Okay. I wanted to ask, what happens when there is a bubble on the debt, R is less than G, but the economy is dynamically efficient? So M is bigger than G, and thus there is an M minus R gap, okay? Complementing Olivia's work, which was on when there's a bubble and the economy is dynamically inefficient. R is equal to M in his economy. In the data, R is less than G, then less than M, falling on Piketty and many others. I made 3 points. The first point is perhaps the most important. Simple debt arithmetic show you that there's a debt revenue term. There's a new term for economists to study. It can be potentially large, and it comes with very different trade-offs when this happens. There is a bubble premium, a convenience premium, a debt revenue term. Second, I showed you one particular model of that debt revenue term driven by misallocation of capital, where the key force is the competition between public debt and private credit markets. To what extent does the debt revenue generates from some services the public debt provides that are going to compete with the private credit? And thirdly, I showed you that you get very different take on monetary fiscal policies and interactions, redistribution, tax cuts paying for themselves, what should monetary policy do when you focus exclusively on this third term. And that's what I did. And that's what trying to highlight how interesting this debt revenue term is, how you ended up with a bunch of different trade-offs that were quite different from the ones that we're used to when studying the other term, the present value surplus. So, okay, 60 seconds below the time, but here I am. Thank you. Oh, you're muted, Peter.
Thank you, Ricardo. It was absolutely great. I would say also very rich. I don't see any questions, I mean, here, which I'm surprised. I have usually my reaction listening to you is trying to fit that to present, policy discussions we have. And for example, when you say price stability, is not in conflict with fiscal capacity, I mean, that's quite interesting because the whole debate today is about fiscal dominance, where central bank, buy a lot of, government bonds and on their balance sheet. That means they have an exposure to government. And what you say, it's very complementary. So that's one part of the discussions we have now. And the other one is related, of course, is that central bankers very often do not trust, the treasuries, because they say a lot of the money is going to be spent, not investment, but, in spurious consumption. So can you make these comments, fit into your presentation? I'm sure they can, because it's I think it's very elegant and very nice the way you present it.
Absolutely.
And then I have a question. I will read it from Mohamed Ali Nazir. There are different interest rates prevailing in the European Monetary Union. So how can we address them in this model? And what implication it can have? I'm reading that. Well, that's a little bit putting your model in the context of a monetary union with different sovereigns, of course, with different sort of credit ratings, which will also be discussed in the next presentation. We have 2-3 minutes only.
Let me ask this question. And Stefania, I think, also has her hand up, but we'll get to her in 3. I'll take 3 minutes to answer, and then that leaves me, I think, 2 minutes for her question. So on the question of how to think about some discussion of fiscal dominance, being a research paper, this was very focused on one particular interaction, fiscal and monetary, and the one that I studied there was the desire to inflate away the debt. What I told you is that, and this is something that's very often debated, is to what extent are we tempted now that, the debt in France and Belgium, everywhere in Europe is so very high, boy, wouldn't it be good if we had a little bit of inflation, inflated some of it away or not? Okay? And what I argue, or what the model showed in this particular model, and, research model as it should be, was that no, because the anticipation of any attempt, any loss of credibility that says you inflate away the debt would lead the interest rates to rise, insofar as right now we have a debt sustainability on account of R being very low, a movement up of R of 1% because expected inflation goes up by 1%. That comes with a little bit of an inflation risk premium relative to the private sector real assets would be catastrophic right now. So that would say that once you have a lot of debt and you're really relying on the debt revenue term, as we have essentially deficits and still big terms, this is not the time to talk about inflating away the debt. You're really in that. This is not to say that sometimes you may not be able to inflate away the debt, but then right now this would be the very bad thing to say. So that's the only thing that I said when it came to monetary fiscal. The issues you raised about whether or a second point though, which is related is, sometimes we talk about to what extent are central banks doing financial repression insofar as we're generating some artificial demand for government debt. And how do we do that? We buy the government debt, and then we issue another state liability, deposit the central bank or reserves, and then we somewhat force banks and households and others to hold it. That would be an example of my repressed financial coercion, which absolutely that will increase fiscal capacity. But as stated in that part of the paper, that's an increase in fiscal capacity that we know is not sustainable. That comes with a very big tax on the financial sector if it happened. And it's not one that we are doing now. We are not in the last 12 months increased reserve requirements 3 or 4-fold. We haven't actually increased them at all in order to force banks to hold these reserves. Second, we pay interest on reserves. Imagine now, Peter, that we were paying 0 interest on reserves and we increased reserve requirements. Well, then we would be economic history of Brazil and Chile in 1982 and 83. That was a way to get debt revenue term. That led to the fiscal dominance that we know came with very bad financial consequences and ultimately hyperinflation in the background. So that's the second link. It's the financial repression part. We're not doing anything like that right now, but that's that dominance that would show up there. Third, on the question.
Third, in a multi-country monetary union, very briefly, and then there is a question from Stefania.
Yes. So it's just on the question then, Mohammed, on the different interest rates. That is a very difficult question, but that's the one that I try to avoid in this model in a good way. Avoid makes it sound bad in a good way. What do I mean? There's an active literature right now, a very interesting literature asking, okay, what's the right interest rate on which to discount the government debt constraint? Remember, I told you any D that's bigger than G is valid, okay? Valid mathematically, but what is the right one? Well, if you start looking at market returns, different interest rates, again, private returns here, the key is not to use the government debt returns, but different interest rates from different private investments. Which one do you use in terms of trade? And there's very interesting work being done by lots of different people trying different ones, arguing for different ones. I came at it from a macroeconomics perspective. And as a macroeconomist, not a financial economist, financial economists say, well, there's lots of interest rates, which one do I use in private returns? I came as a macroeconomist. There is, you either invest in government debt or invest in the economy. And the economy gives you a marginal part of capital. And so that's the right one to use. And that's the argument I made in those slides. Now, of course, I'm avoiding a little bit of your question because then, of course, you can come back to me and say, fine, now how do you measure the marginal part of capital? And of course, there again, we have different ways of measuring that. But from a macro perspective, the alternative to the government is the private economy. And in the private economy, the return is the marginal part of capital. And that's the right answer. I argued in the slide, and I'll continue to argue that's the right one, which is not to say that when you go to measure it, do I use stock returns, private equity returns, different leverage returns, unleveraged, and that's harder. So Stefania, we have 2 minutes, so hopefully still time for
less than 2 minutes, Stefania.
Sorry, Ricardo. Sorry, I couldn't type in the chat. So I wanted to ask you 2 things to understand a little bit better, right? So you're assuming that a debt holder, right, is also a person that would invest in private capital, right? That's why, at the margin. So you're assuming that practically in your model, there's no preference for safety and liquidity, right? Because
not quite. The guy who's investing in the debt is the one, well, there's different guys, but at least in the simple example, he wants to lend to Peter. He doesn't want to invest in capital. It's just that he reaches the limit of how much he can lend to Peter in terms of the collateral constraints. And that's why he saves in debt. So the margin, he's choosing between lending to the productive guy or investing in the government debt.
Okay. And so the other was about the fact that practically the more developed country, right, are the one where the private market compete more with the public debt, correct? So, but then would that lead to a prediction that then in the country where the private market is more developed, the safety premium should be smaller or not?
Not necessarily, just because of, how international, well, let's use the example of the US. In the US, on the one hand, you may say the private market is very developed, but at the same time, we have all of these other countries outside of the US and investors who their private market is very underdeveloped, and they find treasuries to be very, to provide them the safety and liquidity that they want, right? So it's always relative to, right? So that would immediately mess up your correlation. The model would predict if I put it in an open economy setting, that you have all these other investors. Their private capital market is terrible, very underdeveloped. Investing in the private market in the US is difficult. It's easier just to invest in treasury bonds. And that creates a gigantic safety and liquidity premium for the treasuries in one example. So you have to think about the alternative. But you're right, you're thinking about it the right way in terms of the alternatives. But I think we have to stop there, 30 minutes.
Yeah, and Ricardo, there's a last question, but just I will read it. It's related to the moral hazard issue that we hear in Europe. Does it make sense for the ECB to push government yields up to induce better fiscal policy? I don't think you have that in your model, no?
Yeah, no, that just isn't there. Yeah, I
thought you see, if the government is pushing too much in unproductive spending, it will have an impact on M, no? It should.
So what's more interesting here is that we have the standard, like I call that IMF thing. If you invest in productive M, that means you increase the growth rate, present value fiscal surpluses goes up. But now we have this other benefit, which is if you increase M, the marginal power capital in the economy, then the debt revenue term increases as well. So you get a second kick here. So there's a second benefit.
Right. Which is that I fully understood. Yeah, exactly. Perfect. Okay, thank you, Ricardo.
Thank you.
So applause. So we go to Yvan, a paper from Yvan Lengwiler from Basel University and Athanasios Orphanides from MIT.
Just a second.
So we are 7-8 minutes late already, Yvan.
Well, do you expect me to speak faster?
No, just to be mindful.
Okay. So this is a paper that I wrote together with Athanasios Orphanides, and it's about the collateral framework of the ECB, actually of the collateral framework of any central bank, but it really relates just to the ECB. And this is this picture here is the starting point of our analysis. What you see here is the spread between 2-year government bond yields and the overnight interest rate swap. So and you see that this is very different for different countries. It shows that Italy and Spain, for instance, here green and blue, green and red, paid in this episode much higher interest rates on their debt than Germany and France. So these spikes is what we normally refer to as the Euro crisis, and the question is, why did this happen? So some say that it's maybe because the more peripheral countries of the Eurozone have, here Italy and Spain have unsustainable public finance. But we disagree. And this picture shows why. What you see here is the primary surplus as percent of GDP of Italy and Germany over the last, 20 years or so. And you see green is Italy, and it's very comparable to the primary surplus of Germany. It's even a bit higher on average. So it is true that the debt level of Italy was a bit higher than that of Germany, but that does certainly not justify these spikes that we've seen in the previous slide. So we believe there is really very little connection between the fiscal position and these spikes. So in this paper, we develop a model that tries to capture the role of the ECB, that the ECB has played in this whole affair. And we really try to make the model as simple as possible to capture what is going on. In our model, it is the liquidity premium on government bonds over corporate bonds that drives the whole thing. And this liquidity premium is in our model due to the collateral policy of the central bank. So it's driven by that. Okay, now this will not be a technical presentation. If you want to understand all the details of the model, I would like to refer you to the paper. I believe it's much more useful to convey the content of the paper rather than the mathematics. This is a simplified representation of an already quite basic model. There are 3 periods. In the first period, households deposit their wealth in banks, and the government issues bonds. Why does the government issue bonds? In this model, the government issue bonds because it needs to raise a fixed amount just in order to maintain basic institutions, like the judiciary, police, whatever. So the government issue bonds in period 1, and it needs to raise a particular amount of money, which is here G. Okay. Now, in this period, also bank take of course the deposits of the households because the households deposited, and the banks invest in 2-period loans for firms with a return capital R, and they purchase the government bonds who will have a return of lowercase r. Okay, so the banks hold, provide credit to firms and purchase the bonds. Now, in period 1, some depositors decide to withdraw their deposits, and the bank is out of cash. So the bank needs to go to the central bank to get liquidity in order to compensate these early withdrawers. And there are 2 ways of doing this. There are straight repos that the bank can do with the central bank. They are simple and cheap. The bank simply provides bonds as collateral to the central bank and gets liquidity. And a more expensive way is to do emergency liquidity assistance, which in this model amounts to pledging outstanding loans as collateral. This is not free. There is a cost C involved in this, because the central bank has to inspect these loans, and there is a penalty on that. Okay, so you see here the bonds have a cost advantage for the banks because it allows them cheaper access to liquidity when they need it. And the third period is trivial. Everything is rolls, so production ends. Deposits are redeemed, the government taxes in order to be able to redeem the bonds that also mature, the repos mature, and the households consume. So that's the basic structure of the model, and I will not go through the derivations. As I said, the first result is just this. Bonds enjoy in this model obviously a liquidity premium, because they have this cost advantage. So you see a small r is the return on government bonds. Capital R is the return on loans, which in this model is just given by the marginal return to capital in firms. And in this model, we keep that fixed for simplicity. So there are constant returns to capital in firms. Just for simplicity, and C is this cost advantage that bonds have. Okay, so this result is simply a result of an arbitrage condition of banks. Okay. Now, in reality, the ECB uses a large basket of different bonds in repo operations, not just government bonds. And for that reason, they have to assess the quality of these bonds. And for that reason, they use private credit rating agencies. So they might apply a haircut to a particular bond, or they might even exclude a bond completely when the rating is too low. The trouble is they do this also for government bonds. Okay, the ECB uses credit rating agencies also for government bonds, and might have a haircut on a government bond, or might even exclude a government bond completely. So this is what happens when there is a haircut. So H here is the haircut that the ECB imposes in a repo transaction. An alternative interpretation, which is completely it's equivalent, is that H is the probability that the ECB rejects a bond completely from the repo transaction. Okay, so what you see here, if the haircut increases, or the probability or the perceived probability of a rejection of the bond increases, the spread between the corporate bond and the government bond decreases, which means that the government bond has a higher yield. Okay, and in our model, it is changes of H, or perceived changes of H, or expected changes of H, that drive these spikes that we saw a few slides before. This became very clear in practice. We have experienced that in 2016. Portugal, in 2016, the interest rates in Europe declined sharply, but in Portugal, actually, they rose. And the reason is that 3 of the 4 credit rating agencies that the ECB uses had downgraded Portugal, and the markets were waiting for the verdict of the 4th credit rating agency. So if the 4th credit rating agency would have followed suit and also downgraded Portugal, Portugal would have been excluded from being a collateral in the repos, and we would have had a very, very serious crisis in Portugal. Now, luckily, this credit rating agency, this little-known agency in Toronto, as the Financial Times called it, did not downgrade Portugal. So this really major crisis was averted. But the episodes really illustrates the fragility of this whole system. So the ECB makes this haircut conditional on the rating. We don't have a rating in the model, but we approximate the rating by assuming that it is driven essentially by the debt to GDP ratio. So in this model, the haircut will be conditional on the debt to GDP ratio, and this can give rise to multiple equilibria. Why is that? Well, as I said before, the government needs to raise a fixed amount of money when issuing bonds. So if the interest rate goes up, it means it has to issue more bonds, right? Because the bonds are cheaper when the interest rate is higher, so it has to sell them cheaper. So it has to issue more bonds to get infrastructure financed. That means that if you have a high haircut, the interest rate is high. As a result, your debt to GDP ratio will be high, and that justifies the large haircut. If you had a low haircut, the interest rate would be low, the government would have to issue less bonds, and the debt to GDP ratio would be low, which would justify the low haircut. So this is circular. You see this in this graph, maybe. The top left quadrant here is this equation I showed you before. That's the relationship between the haircut and the interest rate on the yield of government bonds. The bottom left quadrant is just the relationship between how many bonds do you need to issue as a function of R in order to generate sufficient public finance to get the infrastructure. And this top right quadrant is maybe the most interesting one. That is supposed to capture the collateral policy of the ECB. In this example here, it's assumed that the ECB will accept the bond with zero haircut if the debt to GDP ratio does not exceed some value beta bar. And if debt to GDP ratio does exceed beta bar, then the bond will be completely, will not be eligible anymore, 100% haircut. Now, in reality, the ECB does not have this particular schedule. What the ECB has is a step function with multiple steps. But it's easy to integrate that. It just makes the analysis, there are many cases that you have to think about. But essentially, this captures what is going on when you have a collateral policy that depends on the debt to GDP ratio, but the debt to GDP ratio is actually endogenous and depends on your haircut as well. Okay, so we combine in the next graph. You will see I combined the left panel here with the right panel here. And you get this picture, and this is essentially the model here. So there are two equilibria. As I said before, you can be in the good equilibrium where the low haircut is justified, or you can be stuck in a high haircut, high interest rate equilibrium where the high haircut is also justified. Okay, I think I'll skip this one for time reasons. So what should be done? Actually, I don't know if how much time do I have, Peter?
You have, 7 minutes.
Yeah, so I skipped that. Okay,
8 minutes, 8 minutes, 8 minutes.
That's fine, that's fine. So what should be done? What we see here is again the same picture as before, but with other countries in there as well. And you see that on March 18, 2020, the Pandemic Emergency Purchasing Program went into effect. The PEP went into effect. And this had initially a very beneficial influence. You see that the yields on Italian bonds dropped significantly. But this measure, it appears, had only temporary effect. So the whole problem re-emerged until in April 22, the right decision was made. The decision that was made on April 22 was essentially a decision to halt the, well, I will explain exactly. You will see in the next slide what it was exactly. But it was the suppression of the revision of the eligibility conditions, essentially. And this was, this illustrates why the collateral framework is in a way, is very problematic. So this is the decision that I talked about from April 22. The ECB says that it will grandfather until September 2021 eligibility of marketable assets. So it will not change which assets are eligible or which assets are not eligible, but this was temporary until, when was that? Until September 2021, right? And then this measure was prolonged in December last year until June 2022. So what this does is it takes out the uncertainty of what the haircut will be. It's very clear what the haircut is because the haircut is fixed now, at least the eligibility is fixed now. And that has calmed the market tremendously. It's essentially what this is it's a quick fix, right? It's not a permanent fix because all of this is, it has a terminal date. But it is a quick fix that has worked. So what should the ECB do? First of all, I think it is key that the ECB should stop relying on private credit rating agencies for assessing government bonds. This is very important. Otherwise, its credit rating agency the decision of private credit rating agencies that will essentially make monetary policy in peripheral countries of the Eurozone. So quite unacceptable in my view. And secondly, I mean, the easiest way to address this would simply to accept all government bonds without a haircut. Now, I understand that this may not be acceptable and may not have a majority. So if that is not acceptable, an alternative would be to use internal debt sustainability assessments for each country. But what is key here is not to use market interest rates for those. So if you do that sustainability assessment for Portugal, you should not use market interest rates because market interest rates are endogenous. They depend on your decisions. So it's circular and you have the same multiple equilibrium problem again. Essentially, the ECB should assume that a country is, is sustainable, financially sustainable, and under this assumption, what would be the interest rate, and then under this, with this interest rate, do the sustainability assessment. Okay, so it would nudge everything to the good equilibrium. So. Of course, I watched the result of the strategy review today, and it was unfortunate. I mean, there are good things in there, of course. I like the 2% symmetric target. Unfortunately, the collateral framework has not been addressed at all. I believe this is a somewhat. I'm sure people in the ECB understand the problem, but it is not something that many people talk about. And I think it's one of the major reasons of the euro crisis. And if we want to avoid this in the future, it should be definitely addressed.
Thank you. Thank you, Yvan. We have 8 minutes for Q&A. Let me read a question from Muhammad El Ali Nazir. Significant changes have been made in the quality of collateral accepted by the ECB. It's true. I mean, over the years, the ECB has gone. For example, in the beginning was single A minus, and then it was triple B minus, and also the range of collateral was broadened. So there have been a number of changes also in the haircut. And do you address this in the model? So that's the question. And on the Portuguese question, Greek government bonds were eligible even below the triple B minimum rating. So is it something worth bothering? Because you mentioned the Greek bonds, by the way. So that's one of the questions I have. The other one, I would agree personally with you by saying that it's strange. I was not in 2005 when the decision was taken to use external rating. But at some point we had discussions in the board to see, do we have to develop our own internal rating system, the ECB internal rating system? The answer was no, because it would expose, the ECB to high political pressures. And so the discussion stopped there, and there were pragmatic reactions, as you described, Yvan, like with Greece recently. But this problem is not solved. I fully agree with you. This is an important point. It didn't come today in the the strategy review of the ECB. So some of us think it's unfortunate. It's very delicate. One of the outcomes some people think is to link it to the surveillance framework, the fiscal framework, the European fiscal framework of surveillance. Because you take the presumption that debt is always sustainable if the central bank considered it as a safe asset. But there are obviously problems of debt sustainability.
Of course.
I mean, you cannot neglect that. And
so
how do you do that? So the ECB always, one way would be to look at the outcome of a strong surveillance mechanism at European level. We have a little bit of that in the recovery fund, but it's not, national public debt we are talking about here. But you have a little bit of that. And then ECB would take that into account. But the ECB at the end will still be free to accept or not, public debt as collateral.
It will, because it cannot be dominated, fiscally dominated by the Eurogroup, deciding that debt is sustainable, because there are a lot of politics there, as you know. But it's quite a difficult thing, and that's why it's still the ratings, because nobody found, an answer to that. So there are two questions. How do you take into account, in your model, what has been done in the softening of collateral? It's not really always softening. Huh?
No, it's not exactly. But we don't take that into account at all. It's a very, very simple model, and we completely focus on government debt. So I have some sympathy for the ECB using credit rating agency when it comes to all sorts of corporate debt, if the ECB wants to have this huge basket of assets they accept. I think government debt is something different. The question that you posed, I think maybe I was not completely clear. I'm not assuming that government debt is necessarily sustainable. Mm-hmm. What I'm saying is, if you do a debt sustainability analysis, you should start from that assumption and work out what the interest rate would be. So essentially, you take the lowest interest rate of all the countries in the Eurozone, and you say, okay, suppose Italy has the same interest rate as Germany. Would its debt be sustainable or not? And if it would be sustainable, then you treat it the same way as you treat Germany. But of course, if under this very positive assumption, the Italian debt would not be sustainable, then a haircut could be justified. Mm-hmm. Okay, so I'm not claiming that all government debt is necessarily sustainable. We have seen sovereign defaults in economic history.
In the ECB, when I was there, we run a lot of, we do DSA, we run a lot of simulation, enormous amount of simulations. And indeed, in some simulations, you take the market rates, the future rates. Yeah. And at some point, of course, then that is not sustainable because in some situations, of course. That's clear. But we run a lot of simulations, of course. And what you found in a country like Italy, for example, is that there is one case where it's unsustainable when you have a sort of recession with high interest rates. So it's sort of but for the rest, it was very resilient to high interest rate. But it's just a combination of the two that was the main problem. But obviously, there are many cases, and you can quickly go from one equilibrium to the other equilibrium. That you're absolutely right. You shift very quickly. In the pandemic, that's what I wanted to say. In the pandemic, you remember that Christine Lagarde started to say, we are not here to close the spreads.
Oh, yeah. So I saw that live.
So you didn't explain that in your presentation, but that created a big,
of course,
a big reaction in the market. And then after, it was corrected by saying, we will intervene for to lean against non-fundamental volatility of spreads. And that's ambiguous because it was added during the pandemic crisis phase. And so everybody's guessing when is the crisis phase over and what will be the policy after. Yes. Are you going to go backwards or not? That's why some are disappointed that this problem has not been addressed in the strategy review because it's still there. It's extremely delicate in the monetary union, but I fully agree with you. It's something that will have to be tackled, and when the pandemic crisis will be over, I cannot imagine that you go back to the old model by saying, if there is fragmentation in the transmission of monetary policy because of nervousness of markets about debt sustainability, and that's related indeed to the ratings and to market, assessment. And if you have a sort of circle that you explain, of course, it feeds back. Yeah. And I think that has to be tackled. It was tackled successfully, as you say, in the pandemic crisis. But you immediately say in the second wave, which we have seen, that it was also the political signal that was important in compressing the spread. So you needed both, not only the central bank.
But look, the ECB is supposed to be independent, and this is the center of monetary policy, to control interest rates in all your member countries. Of course, the ECB is in a unique position because it has not just one country but several. I find it very difficult to stomach the idea that it's in the end a political institution that will decide about the spread between the interest rate between Spain and Germany.
No, the ECB would take that as an important information, but that would not be the end. We always said that, you know, you will take into account debt sustainability analysis from the other side, from the political side, but you remain independent and on your own judgment. Of course, so there are different debt sustainability analysis, you know, around. You know. And,
actually, Peter, I think Ricardo has raised his hand as well.
Oh yes, Ricardo, please. We have very few minutes.
Yeah, sorry, because the Q&A only the attendees can do it, not the panelists. Yeah, I mean, one question with just picking on the imagine there was no haircut on government bonds. I mean, if we're thinking about direct purchases by the ECB, I understand how you do that. But if we go back to the old approach, almost last century, of having an MRO rate and then you can post whatever collateral you want. I mean, if the markets have different haircuts, then the ECB is, of course, going to get flooded in any MRO operation with all the ones for which the market haircuts are too high, right? So you have this negative selection where you just get the ECB getting flooded with a lower quality one. And if it doesn't itself follow its haircut. So do you see that as a problem or just a detail?
I'm not sure. I mean, if there is a bond out there that has a lower quality, that is perceived to be of lower quality, it will have a higher interest rate and therefore a lower market value. And the ECB uses the market.
Yeah, but I was saying the markets apply different haircuts to different bonds. I mean, we can say, well, that's weird because there should only be different interest rates. But what we observe is there's different interest rates and different haircuts. So this would be would be less liquid in the market sense.
Okay. So you're talking about, when you say the market, you mean the banks, right? Exactly. You mean the banks right? Okay. Well, you know, if the ECB uses zero haircut, I think the banks will also use zero haircut because they know they can use this bond to get liquidity very cheaply at the ECB for zero haircut.
Yes. Yeah.
I think the central bank is leading the banks. It's not the other way around.
Okay, I think we can go to the next presentation. Thank you very much, Yvan. Bye-bye. Thank you. To the next paper, Stefano, you there?
Yes, I'm here.
So we have Stefano from the ECB. So there are 3 contributors. And then you're going into this section, you know, about the spreads. You know, you make spread analysis and in risk premium. Please, Stefano.
So the title of my presentation is Euro Area Sovereign Bond Risk Premium during the COVID-19 pandemics. It's a joint work with Niklas Grimm, who is leaving now the ECB to join the Columbia University as a PhD student, and Bernd Schwaab. So the motivation is really simple here. So the outbreak of the COVID-19 in February 2020 had a pronounced impact on the euro area sovereign bond yields. The health emergency of the health shock was common across the countries, but some countries were hit earlier and harder by COVID-19, and countries were hit while being in different economic and fiscal position. So the asymmetry caused sovereign yields to diverge, preventing the even transmission of the ECB common monetary policy, and also preventing favorable financial conditions for firms, financial institutions, and households, because we know that usually sovereign yields are used to price loans. Now, of course, we know that European policymakers step in. ECB did several things. Maybe the most important action in terms of sovereign bond yields was the announcement of the Pandemic Emergency Purchase Program on 18 March 2020, while from a fiscal point of view, the European Union announced the EU Recovery Fund in April 2020. So what we want to do in this paper is to assess the impact of this policy action on the sovereign yields, but we would also to understand what are the main channels. We would like to understand which bond risk premia are the most relevant during this COVID period, and also which bond risk premia are affected by this policy intervention. Let me tell you what we do in one slide. So our starting point is a paper by Krishnamurti Nagel and V.C. Jorgensen that was published in a Review of Finance in 2018. In that paper, they evaluate the impact of the ECB action, like the security market program, the free LTRO on sovereign yields of Italy, Portugal, and Spain. What we do is a sort of similar exercise in the sense that we decompose the sovereign yields for France, Germany, Italy, and Spain in several components: default risk premia, redenomination risk premia, liquidity risk premia, segmentation premia, over a different period from 2015 to 2020. And after extrapolating these components, we also ran an event studies to understand the impact of the PEP and the next generation EU recovery fund announcements. Let me give you a short preview. What I'm going to show you is that all these yield components are economically important, but the relative importance varies across countries and time. If we are sitting on the spring 2020, we see that default, redenomination, and segmentation premium constitute the bulk of Spanish and Italian yields. The default risk premium is almost 41% for the Italian yields and 28% for Spanish yields, while in terms of redenomination, we see a 20% for Italian yields and 16% for Spanish. On the other side, if I take Germany, essentially, if I'm looking and I'm analyzing the German yields, what I see is that they're mainly driven by two components. What is the risk-free components and the third premium, and the segmentation premium that, or convenience yield, similar to what Ricardo has spoken about, accounts for almost 37% of the yields. In terms of the event study analysis that we ran, what we see is that the PEP announcement benefited especially Italy and Spanish yields, lowering in particular default and redenomination segmentation premium, while it seems based on our analysis that EU fiscal policy announcements lowered yields more uniformly across the four countries. So let me talk briefly about the model, the framework that we have in mind. So if you take like sovereign bond yield, for example, at 5-year maturity of a country like Italy, you can think that there are several components. There is the classic components, that is the expected short-term rate plus the term premium. The term premium captures the duration risk. This component is sort in common across all the euro area countries. And then you have two specific components that are related to sovereign default. The first one is default risk premium, that accounts for the probability of default and the loss given defaults, and also for the market price of the default rates. So this premium accounts for what you can define as a fundamental risk, like the probability of default and the loss given defaults, and what is the market price or risk of the risk aversion of the investors for these default states. This component does not take into account the possibility that the country defaults and exits also from the euro, issuing its own currency. This is captured by the redenomination risk premium. Finally, we have other two components: the liquidity risk premium that captures more standard bond market liquidity risk, and finally a segmentation premium that can be interpreted in two ways, depending on the estimates or the results of the estimates. One interpretation could be that this segmentation premium is negative, so you have a convenience yield. And we have so many papers recently that they try to document that there are non-pecuniary benefits for sovereign bonds, in the sense that the investor who is holding the bonds, he has benefits on top of the cash flows. And what we have in mind here is that if on top of that, there is some price pressure that is provided by the ECB via QE, this segmentation premium, this convenience yield can be reinforced. Or the other way around, you can have a positive premium, so a discount on the price of the bond, when, for example, you can have a situation like you can have in a bank sovereign nexus. If the sovereign is pushing the banks to hold the bonds, maybe they might demand a premium for holding these securities. In terms of the identification that we use, the first component, this risk-free term premium component, is captured by the euro overnight index swap rate. The default risk premia are captured by the credit default swaps that we define here as the ISDA 2003. So what they are called now the old CDS, that they give protection in case of default, but not in case of a redenomination. So redenomination is not a credit event feature that is captured by this CDS. What happened is that after the Greek crisis, there is a second type of CDS, what is called 2014, where the redenomination is included as a credit event feature. The way I see it is like, when you buy insurance for your car, you can have like the base contract, but on top of that, you can add like a sort of custom insurance to have a full protection. And this is a sort of what gives you this CDS with this 2014 feature. Finally, liquidity risk premium is going to be captured by some country-specific liquidity factors that we use in our Kalman filter approach. And the segmentation convenience premium is going to be the residual of the model. As I said at the beginning, we are building on Krishnamurti, Nagel, and V.C. Jorgensen. The main difference is the identification strategy. What they use to extract the sovereign default. Here they're using sovereign US dollar bonds issued under the foreign law. The problem with this type of way to infer the default, in this case, you use these bonds because essentially it's like Italy issuing US dollar denominated redenominated currency. The point is that Italy is the only country that regularly issues this type of bonds. And finally, to extract the redenomination component, they rely on corporate bonds issued in euro under the local law. And the assumption here is that these bonds can be affected by redenomination, in particular, if these bonds are issued by the international corporation. But the assumption here in their identification strategy is that there is no nexus between the corporate company versus the sovereign. For example, when they use the Spanish case, they use the bonds issued by Telefonica versus the Spanish sovereign. But we have to say that the point is that what they have analyzed in their paper is the euro sovereign debt crisis. At that time, there were not these two types of CDS with and without redenomination. So they have to use this type of the identification strategy. However, I would say the main advantage is also with our approach is that essentially we can cover all the main countries, Germany, France, Italy, and Spain, and we are almost covering 67% of the euro area GDP. Finally, we extend their framework to account for liquidity risk premium. Everything then is estimated using a standard Kalman filter approach. Okay, so in terms of the decomposition, let me show you first the continuous black line. It is an Italian sovereign with a 5-year maturity. Here, what I'm plotting here is the short rate and term premium component, which is the green dashed line. What you can see is that the 2 times series, there is some positive movement. However, in some situation, there is a sort of disconnect between the two, in particular in the spring 2019 that I'm going to discuss in a few minutes, and also more recently during the COVID period. But overall, you can see that this component plays a sort of minor role. The default risk premium instead plays the dominant role in explaining the Italian sovereign yields, and this is to some extent similar to what you see in the Moody, Nagel, and V.C. Jorgensen paper. It's almost on average 100 basis points if you consider this period sample from 2015 up to now. What is interesting is this redenomination risk premium that captures some sort of a political uncertainty. In the first part of the sample, this premium was completely flat. Then there are 2 episodes. I'm going to discuss only the second one. In this case, there is a jump of this redenomination premium of almost 100 basis points. At that time is when in Italy, there was this government formed by Lega and the 5 Stars movements. that triggered a lot of political uncertainty from May 2018 to September 2019. And then when they formed a new other type of government, there is also a drop in the yields and a drop in the redenomination risk premium. But as you can see in this period, the yields were pretty high. They reached almost 3%, although still ECB was running at the PSPP. And 100 basis points of this was mainly driven by this redenomination risk premium component. Finally, the liquidity risk premium most of the times is super tiny, but it can show up in crisis time. Our estimate is that it was around 15 basis points during the March 2020 at the peak of the COVID crisis. Finally, the segmentation premium, that for us is also quite an interesting component. As you can see also for Italy, this segmentation premium is negative. So this is what we interpret as a sort of a convenience premium. It was quite substantial in the first 2 years of the PSPP. It's almost around zero during this period of high political uncertainty. And then it's almost negative again more recently. So if you want to take all these components to look in a very integrated way, this is a chart that to some extent where you can see the continuous black line, the Italian sovereign yields, and all the components, what is the weight of these components in explaining the Italian sovereign yields. On the right-hand side here on this panel, we show the contribution of these components during the spring 2020. Of course, we can take the opposite case. I can take Germany. This is the chart for Germany. The green area is the risk-free component, that is the short rate and the third premium, while this yellow area represents the convenience premium, the segmentation premium. That is almost 37% for the German yields. So this is just confirming to some extent what in part we know, that the German bonds are the sort of the safe assets in the euro area. Although all the other euro area countries, they demand or they show a negative segmentation premium that we interpret as a sort of convenience yield. Okay, then what we do is an event study analysis. It's very simple. The event study analysis, usually we run it on change on yields, but now you can also run on change in the components that you have. We have a set of dummy variables to capture this 2-day event. And then K is going to be our beta that is going to measure the surprise component in each announcement. Of course, every time that we run this type of analysis, we need to keep in mind that other news might be around these events. The program can be partially anticipated by the market. And of course, the market reaction not necessarily equals the ultimate impact of the program. Here we are just looking at the window or the 2-day event window, okay? Okay, so in terms of the PEP for the Italian yields, the PEP was announced on the 18th of March. The Italian yields reached almost 1.96%. There was a drop of 78 basis points. But what is interesting with this type of framework is that you can analyze which are the drivers of this drop. And so what we observe is that there was a drop of the 35 basis points of the default risk premium, almost 14 basis points for the denomination risk premium, and then 16 basis points for the segmentation premium. ECB on June 1st announced another expansion of the PEP, and then you observe another drop in the yields that again is mainly driven by the default risk premium and redenomination risk premium component. What is interesting is that you can do the same type of exercise with Germany, and what you see is that it's quite interesting. So you see an increase in yields that is mainly driven by this short rate term premium component that is common across all the countries. So the yields went up of 24 basis points. This short rate term premium component went up of 13 basis points. Our interpretation is that at that time, ECB announced several things, and people, investors might have expected also a cut in the interest rates, which did not happen. And so that was the reaction on the OIS rate. But overall, if you look at all the countries, we see that there was a sort of asymmetric impact on the yields. So Spanish, Italian yields went down, German and French yields went up, mainly driven by the short rate term premium component. And our interpretation is that this asymmetric impact can be attributable to the fact that the PEP is much more flexible in terms of bond purchases compared to the PSPP. So with the PEP, the ECB can deviate from the country limits. Finally, if we look more to the fiscal announcements with the EU Generation Fund, the fund was announced on the 23rd of April. The Italian yields decreased by 23 basis points. And this drop of 23 basis points was essentially driven by all the components, by the default risk premium by 14 basis points, redenomination by almost 3-4 basis points, and the short rate term premium as well of 5 basis points. Again, there was another drop of 23 basis points on May 18 when Macron and Merkel announced their proposal for the EU Generation Fund. But overall, also, if you run the same exercise for Germany, there is a drop, and again, but this is mainly driven by the short rate term premium component. Interesting enough, it seems that during these announcements, although we are really measuring few basis points here, you see a positive impact on the segmentation premium. So it seems that the German bonds are losing part of this yield convenience yield, but of course still 1 or 2 basis points. So let me summarize what we do. So essentially what we do, we decompose euro area sovereign bond yields into their most relevant risk premium. We study the impact of the ECB monetary policy and EU fiscal policy announcements during the COVID recession. We find that both ECB monetary and EU fiscal announcements had a pronounced impact on yields, but mainly affecting the default redenomination segmentation premia. When we look in particular to Italian and Spanish yields, what we find is that the PEP announcement benefited vulnerable country, and we think the impact may be attributable to the unprecedented flexibility when implemented bond purchases. Finally, what we see is that the EU fiscal policy announcements lower yields more uniform. And I'm done.
Thank you, Stefano. Thank you a lot. I don't see any question yet. I have one. You may not like it, Stefano. Other question? I mean, you will see. No, you don't have to answer if you don't like it. On the events, I have a question here.
Yes.
On the events, have you tried to separate April 22 from April 23?
No. Why? Sorry for
I don't know. I don't know. I read the whole question. 22 and 23. What? I was not there, so.
I think we tried to. Of course, there were so many events during this period that you need to be.
Yes.
But I think here what we try to look is really to this.
That was the next generation.
Recovery fund.
Yes, the recovery. When was it exactly? The 23rd, no? The
yes,
recovery fund.
I think that is what we checked. I think also we always try as a robustness to move the window to see whether the results are still there, because essentially the problem is also during this period that there are so many events that.
Yes, and the April 22, I just got the answer. You have the collateral framework, the change in the collateral framework, April 22. And so there are two events, in a very short window.
I think we checked that. That's true. But we think that to some extent, at least for the countries that we are considering, the change in the collateral framework was affecting more other countries than the one that we are looking.
Stefano, you don't have to answer, but it's related. You know that the ECB, that was in a speech of Philip Lane, that the ECB would counter any non-fundamental volatility in spreads. It's also related a little bit to the previous presentation of Yvan. So from your perspective, as crunching the data, how would you say what is fundamental, non-fundamental? Because when the ECB, gets in a very tricky situation. You understand my question, of course, in a very tricky situation, because also the language has changed over, over time. Because, after we are not here to close the spread, which I understand why the president said that.
Yeah.
But then immediately it was, in this special, period, you have to counter non-fundamental volatility of spread. And then it came later, we have to counter fragmentation or to ensure that, our policy is transmitted to all jurisdictions. I think as a researcher, I think it's important to reflect. I don't think there is an answer because everything is endogenous. But I think it's very important to think about, if the ECB as a policy later looks at fragmentation as one of the, the mission is to avoid fragmentation in the transmission. What is the sort of input the central bank would use? And then they have to look at, what are the sources of, spread widening. What are the sources? So the sort of analysis you do is quite important. But then you have to discriminate what is fundamental, not fundamental. Good luck. I don't know if you want to have a general answer to that.
No, if you want, I can answer. So I can tell you, this project was born as a sort of policy work. It was not like it started as a research. So essentially, this was born essentially 1 year during the COVID crisis. And we had a huge discussion also with Isabel Schnabel and Philip Lane about the results that I've just shown. Mm-hmm. And I think it's related to the point that I was discussing before. So when we get these components, this premium, we cannot distinguish between what is the market price of risk or what is, the risk aversion of the representative investors and what is the fundamental risk. So the probability of default and the loss given default. Yeah. So we cannot distinguish between these two. The only thing, of course, that we can look at when we look at these components, if we see that these components across all the countries, sometimes after ECB action or some EU fiscal policy action, they can move in a similar way. So they move to some extent into some direction. Then if they move in some direction or in a similar direction, then you might claim that, maybe you're affecting the market price of risk or the risk aversion of the investors. That is something that to some extent you would like to some extent not to control, but at least to affect.
Interesting. Very good. Very good. I get another comment about this, the previous question. April 24, there was expected downgrade of Italy by S&P. April 22, the collateral decision took that off the table. Are you sure the collateral decision was not important for Italy?
Yeah. Okay, so I think I will recheck and then I think we ran it for several events, but I will check again the results. Yes.
Okay. Thank you. Thank you, Stefano. It was very, very clear. And thank you for
I think Stefania has a question also.
Very good. Please, you're welcome, Stefania.
Hi, Stefano. Ciao. I wanted to ask you one thing. So when you do the estimation, right, are you assuming that all these risk factors are independent from each other or you allow them to be correlated?
So we have different versions of the model. We also look at the correlation between these factors. I think it's something that we discuss in the paper. I think we have some weak correlation between the default and the redenomination component that to some extent is something that you might expect. But it's something that we did, and also we discuss in the current version of the paper.
Yeah, because I was curious. Yeah, that's precisely what I was thinking. That these two were at the probability to be the most correlated. So in that case, in that estimation, would the redenomination component of the yield spread be a little bit smaller or no? It get in part absorbed by the default risk.
Could be.
I could be. I need to check maybe with Bernd. But I think we really tried several specifications to see which one was the most robust one, and also parsimonious because we have to estimate several parameters. But yes, it's something that also what we discuss is that, of course, what you might expect is a positive correlation between default and redenomination and default and liquidity, because usually there is also a movement in this component.
Okay. No, many thanks. It was an interesting discussion. Yeah, now we have the last paper right on time, Stefania. So are you ready? Here it comes. Perfect.
So can everybody see the presentation?
Yes, it's perfect.
Okay, thank you so much. Thank you so much for having the paper in the program. I'm very excited to present at this conference. So this is a joint work with the Tim Seida that is also leaving the Chicago Fed to do his PhD in Northwestern. So let me just give you a little bit of background. Okay, so we know that at the zero lower bound, starting in late 2008, the Fed started resorting to balance sheet policy, and including Treasury quantitative easing. Okay, and so from 2004 to 2014, the Fed was buying assets, so it was expanding the balance sheet size. And then from 2017 to 2019, the Fed starts slowly reduce the size of the balance sheet running off the asset. Okay, this paper is only focused on one channel of the transmission mechanism of balance sheet policy, and that is the supply scarcity channel. Okay, this is a channel that relies on imperfect asset substitution. Okay, and therefore it relies on the assumption that there is a stable demand for certain asset from a certain class of investor. And so when the Fed enters the market and reduces the supply, this creates an excess demand. And this excess demand cannot be satiated completely by substitution in other assets because the assets are not perfect substitutes. This implies that the price goes up and the yield goes down, and they also goes down for similar assets. Okay. And since by now there is ample evidence on this type of channel, I'm not going to discuss the evidence on this particular channel. What we are more interested in is analyzing the evolution of this channel and its state dependence. So in particular, relative to the literature, we're trying to explain where this paper is coming from. So usually in microfinance model of QE, all of this model relies on, in all this model, imperfect asset substitution arise from market imperfection that practically restrict arbitrage, okay? There are many forms. Some are capital constrained, some are limited risk-bearing capacity, some are large transaction costs, some are limited market participation, and here are some paper, but not all of them. And all of this type of paper implies that in normal market times, okay, as most of this market friction, imperfection, distortion wane, okay, then arbitrage become more efficient, and therefore the change in price induced by change in supply of assets becomes smaller or temporary, okay, and therefore balance sheet policy become less effective. This under the assumption that once the yields goes down, right, the transmission mechanism to the rest of the economy is very similar to conventional monetary policy. So then this type of mechanism is usually used to justify the fact that over time, as market conditions improve or the balance sheet of the Fed, of the central bank increase, we should observe that QE has diminishing returns, okay? Or we should observe that an asymmetry between purchase and sale of assets conducted by central bank. In another sense, since QE is usually conducted during crisis when market function is more disrupted, we should see bigger effect. But when we see the Fed reducing the balance sheet, so or reducing the purchases, or which is in some sense equivalent to a sale, then we should observe almost no effect because the market is back to normal. We are in economic expansion and recovery. Okay. However, in the literature, there is little evidence on the evolution of supply effect during QE, and in particular, there's no evidence on the effect during QT. Okay. So then, what we're trying to do, then we are trying to analyze how the sensitivity of treasury yields to asset supply shocks evolves. Okay, In particular, we're trying to see how it evolves within QE and within QT, and then across QE and across QT. And then we try to understand if these effects are consistent with the prediction macrofinance model, okay? So then what we find that when we put a lot of effort in trying to control properly for balance sheet policy expectation, okay? Meaning, similar to conventional monetary policy, we are focused on computing the unexpected change in the policy tool, right? Usually we do this with the federal funds rate. Since Kuttner 2001, everybody has been focusing on the federal funds rate surprise, so the unexpected change in the federal funds rate, but not everybody has put the same effort to do that with the balance sheet policy. No, not everybody has been trying to focus only on the unexpected change in balance sheet policy. But in every policy tool, we just should focus on the unexpected change, okay? And so what happened, when we control for balance sheet policy expectation, then we don't find that the yield sensitivity to the supply shock is monotonically decreasing over time. And we also find that on average, the impact during QT is at least as large as during QE, okay? But what we do find that seems to amplify the effect is the uncertainty about the balance sheet policy, okay? And very soon I'm going to explain how we measure that. So what are the implications of this finding? Then, first of all, it means that it is important to distinguish between the expected and unexpected component of the balance sheet policy, okay? So therefore, it's important to quantify the surprise. And second, we find that it's not necessarily true that there are diminishing return to balance sheet policy, either as the balance sheet increases or as the market conditions go back to normal. And therefore, it seems that these asset supply effects are not necessarily just the result of market friction or distortion, okay? But they are affected by balance sheet policy uncertainty, which in some sense, in some model, we can see as a form of distortion, but I haven't seen any model yet that is focused on balance sheet policy uncertainty. Okay, so what are our innovations? So as I said, we put a lot of effort in accounting about the size of the supply surprise across QE and QT announcement, okay? And to this purpose, we use the survey of primary dealer and also the operational detail about the maturity distribution of purchase and sale. So what do I mean for sensitivity? The sensitivity is the ratio between the change in yield during the announcement and the size of the surprise, okay? So what happened that if in previous research, we do not control correctly with the surprise. I'm not saying that we are doing correctly, at least we are trying, okay? So what happened that we tend to underestimate the yield sensitivity because we are not properly controlling for the denominator of this ratio, okay? And so instead we find that on average, it's not the yield sensitivity that is decreasing, it's the size of the surprise that is decreasing as the central bank communication gets better, as investor understanding gets better. And so what means? It means that we just observe smaller yield changes because the shock is smaller, right? But that would imply that the ratio is not necessarily declining, okay? And so how do we do that? Similarly to a couple of other papers in the literature, one that I wrote with the other co-author in 2013 and a couple of papers from the Bank of England, we exploit high frequency changes in high frequency relative yield changes of all the outstanding security, okay, treasury security. This means that we do not focus only on a few constant maturity yields on the curve, okay, because that does not allow you to exploit all the relative yield changes that are crucial to this identification, okay? And so, and by doing this, practically allow us to identify the sensitivity by relying on a minimal set of assumptions, okay? And then in particular, once we control for the balance sheet policy surprise, then we can interact with our measure of balance sheet policy uncertainty and see if the effects are amplified by uncertainty. So these are the events on which we're going to focus. And so there are 8 events, 4 from QE and 4 from QT, okay? Usually people is more familiar with the QE events, but and the QT events are, for example, a continuation of the taper tantrum that started in May 2013. And then we have a delay in the start of tapering And then we have the release of the normalization addendum. They provide a lot of details on how the Fed was planning to reduce the balance sheet. And then there is another surprise about the moment in which practically the Fed decide to stop the reduction of the balance sheet sooner than expected, and therefore the terminal size of the balance sheet was going to be larger than expected, okay? So however, as you can see, these events go from 2009 to 2018, and therefore they span very different macroeconomic and financial environments. And so we're trying to see if there's certain dependence, state depending in the supply channel, okay? And what matters, what is very important, this event is that the announcement, the FOMC announcement included a lot of granular information about the policy, the change in balance sheet policy, and that is precisely key for the formation of this kink in the yield curve reaction that we're going to go to exploit. Let me give you a few examples, okay? So these are the QT events, okay? So here we are plotting the change in yields, okay, in a small time window around the FOMC announcement. And these are the change in yield for all outstanding securities. So as you can see, we are exploiting the change in yield across the entire yield curve, and that is crucial, okay? Not just in few security. And practically, you can see that there are a bunch of kinks. For example, during a SAP, there is a kink around the 10-year maturity, where the slope of the yield curve reaction goes from flat to positive, and then something very similar happened during their investment. And then, for example, during the maturity extension program is even more astonishing. The kick is a 3-year, because you have an increase at the short end of the curve, because that is where the Fed was going to sell assets to buy more assets at the long end. And therefore, at the short end, the yield goes up, and at the long end, the yield goes down. And therefore, that creates a change in slope in the reaction. And that precisely this change in slope from positive to negative, or from flat to positive, that, or vice versa, that we're going to exploit in our identification, okay? In the interest of time, I'm going to give you just more example about QT, because people is less familiar with the surprise about QT, okay? But there are a lot of details in the paper also about QE, okay? So for example, you can observe that also during the QT events, okay, there are all this type of sharp kink, okay? And in particular, I'm gonna give you an explanation about the June 2013, so the top left panel and the bottom right panel, to give you an illustration of how the kink forms and how we compute the surprise, because that is gonna really give you an idea of how detailed the survey of primary dealer compiled by the New York Fed before the FOMC meeting, how much details it contains, okay? So for example, during QT events, there is even more information, because at that time, the New York Fed was running the primary dealer survey twice, before the FOMC announcement and soon after, precisely to capture the change in expectation induced by that announcement, okay? That's why you can see that for each table, there are 2 dates. June 10th is the result of the survey before the announcement, and June 24th are the result of the survey after the announcement, okay? And the survey at the time was asking the primary dealer expectation about the pace of purchase, okay? So let's remember that at the time we are doing open-ended QE, right? So like every month we are purchasing, and so it's not clear when the Fed is gonna stop the purchase, okay? So at the time it's June 2013, and every month we're buying 45 billion of treasury and 40 billion of MBS, okay? And the orange square highlights when the pace is supposed to be reduced. So you can see that in June 2013, they are expecting that the first pace reduction is gonna be at the end of the year in December. But soon after the announcement, during the press conference of Bernanke, the comments of Bernanke get perceived as a little bit more hawkish than expected. And so they revise the beginning of the reduction in pace from December to September. Okay, so now they expect tapering to start 3 months sooner, okay? And the difference in this pace allow me to compute the surprise, okay? And the same is true for MBS. Another relevant example is the one of the last announcement. So now it's March 2019, we are in full recovery, markets are perfectly fine, And at this time, the FOMC announced that the reduction in the balance sheet size is going to terminate sooner than expected, okay? Which means that the Fed is going to invest more at auction, which is equivalent to more purchase because they're taking out supply from the market, okay? And this creates a dovish surprise. But how do we compute it? So if you see in the picture, the black line represents the amount that is supposed to expire in each month, right? So this is the amount that the Fed would have to reinvest at auction if he wants to keep the balance sheet constant, right? But they're trying to reduce the balance sheet. So practically, they are going to reinvest only the amount above the redemption cap, okay? So what are the redemption cap expected by primary dealer are in the primary dealer survey, and they're represented by the blue line, okay? But then the announced cap at the FOMC announcement, the red line, are much lower, which means that the distance between the red line and the black line is how much is going to be reinvested at auction, okay? So it is clear that at this point, since the actual caps is below the expected cap, the Fed is going to invest much more than they expected, okay? And so this creates about 51 billion dovish surprise. So, but that is how we compute the surprise for each of these events, okay? Now, why the kink forms in, for example, the 5-year maturity, okay? This is to understand, we have to understand the investment rule, okay? And the investment rule at auction has been the same since 2010, okay? So the investor knows this rule very well. So once you have the surprise based on the investment rule, it's very easy to understand at which auction they're going to roll over this quantity. And you can see that the sector that is most affected is going to be the 5-year sector. And that's why the peak of the surprise is at the 5-year sector. And therefore, you can see in the picture that the peak of the decline yield in the bottom right panel is precisely at the 5-year. Okay, so usually the king seems the result of very targeted trading by very well-informed investors. Okay, so what do we do then? We exploit the sharp kings in the entire reaction of the yield curve to identify the supply effect of the announcement. Okay, and the assumption that we require is that the only channel that has a discrete jump at the kink is the supply channel. All the other channels have to be continuous smooth function of the maturity. Okay, so practically it's only the supply channel that has a discrete jump in the maturity sector adjacent to the kink, while all the other channels can change, but if they change smoothly across maturity, then they're not going to affect our estimate. Okay, this is typical of estimation based on kink design. And we do believe that signal, so the expectation channel and the duration risk channel in all models are a continuous function of maturity or continuous concave functions. So that will be supported by the theory, but is also supported by the empirical evidence. Okay, maybe the only one that would be able to create a kink is calendar-based forward guidance, right? Because then you have a precise day in which you have a lift-off in the policy path, but there are none of this case in the events that we chose. So there's no calendar-based in our announcement. So what is the advantage relative to previous study of this particular way of identifying supply effect? First of all, we don't need to combine yield changes across selected events, and so we don't need to pick few events, few consecutive events and take the sum of the change across events, because we control for expectation all the way up to a FOMC announcement, okay? We don't need to control for other proxy of the other channel under the assumption that they evolve continuously and smoothly across maturity. And in particular, the estimation at this point doesn't need any assumption on the specific distribution of the balance sheet policy surprise. That is entered at a later stage, as I'm going to show you. Okay. So what is our empirical specification? Okay, so First of all, we focus in a 3 maturity window around the kink, and we also did robustness using only 2 years window around the kink, because that allow us to exclude change in duration risk, okay? Because a window of 3 or 2 year around the kink is less than 1 year duration, and so practically, even if there is some spillover, duration risk should be minimal, okay? And so we have the change in yield for each security, okay, in a small time window, delta t around the announcement. Tau I is the maturity of the security. K is the kink location in the maturity range, okay? And in particular is the peak of the yield curve reaction. And then we have a dummy that is 1 to the right of the kink. So if at that point, the maturity of the security is larger than the kink, okay? So beta 1 will identify the slope to the left of the kink, and beta 2 will identify the change in slope. And that is going to be the causal effect of the supply, of the change in supply, okay? And you can see that at this point, the surprise measurement does not enter in the equation. Everything is just function of maturity and kink, okay? So, later, then once we compute the yield change, then we will have to normalize, okay? Because only once you normalize for the surprise, then it makes sense to compare the relative efficacy of the consecutive events, okay? And so in this case, we can provide a range of estimates because every type of measurement of this surprise requires some assumption. So we provide an upper bound and lower bound, okay? We can use the size of the local surprise, meaning the relative supply change only around the kink, okay? This would imply a high segmented market hypothesis because this would imply that yields around the kink respond to change in supply only around the kink, okay? Or we can use the total surprise, which is assuming that all the yield respond equally to the surprise independently of their maturity. And each of them have limitations. That's why we prefer to provide a range, okay? So the first row of this table show the estimation of beta 2, that as I show is the change in slope, okay? And so it is independent of the size of the surprise at this point, okay? And this is in basis points, okay? Then we have 2 versions of the surprise size in the second and third row, okay? Then we normalize beta 2 by the size of the surprise, and that's how we obtain the lower bound and upper bound on the treasury yield sensitivity, okay? And you can observe that going from the first event in 2009 to the last event in 2019, that these effects are not monotonically decreasing over time or even across consecutive programs, right? But they go up and down. And also you can see that on average, in the last 4 events, which is QT, okay, they're at least as large as QE impact, okay? And so then we try to understand if it is not market friction or market condition in the traditional way that cause this variation in the sensitivity, what can it be, okay? So then we start noticing that every time there is a new type of program, so for example, the first LSAP has a larger sensitivity. The first maturity extension program has a larger sensitivity. So this is a new program, different from QE because it's based on practically duration, changing duration, not in the size of the balance sheet. So this is something new that investors need to learn, right? Then there is the tantrum, which is a new phase because now, for the first time ever, the Fed has to learn to wind down a gigantic balance sheet. This is something new again, okay? And then there is again a change in the caps that is something new that also investors have to understand. So then we start thinking that maybe is the novelty of the program and therefore uncertainty about the program that might elicit larger reaction, okay? And so that's how we start measuring, we start going to the balance sheet policy uncertainty. So these graphs are showing 3 examples of how the uncertainty evolved during 3 types of announcements, okay? And what we are plotting here is the change in the volatility implied by swaption on the 10-year rate, Okay, so this is uncertainty at different horizon, from very short to 10-year horizon, on the uncertainty about the 10-year rate. Okay, so why we are concerned about why we favor this measure? Because first of all, swaptions are very liquid, also very long maturity for very long-term rates. Okay, and we know the balance sheet policy is more affecting on long-term rates. So this is the type of volatility that we want to capture. We want to capture volatility about long-term rates and possibly also a long-term horizon, okay? While instead, we think the forward guidance affect more volatility at the short end of the curve about short-term rates. So the red bar show how the uncertainty change at each of these horizons, okay, before the meeting. So for example, you can see for the first SAP, the red bar are positive. This is saying that the implied volatility went up before the meeting, okay? And then on the day of the meeting, there is a resolution of uncertainty, so the volatility goes down on the day of the meeting, okay? Then what happened? The investment program is also very interesting because the volatility goes down before the meeting, okay, suggesting that now probably the central bank learned to communicate better and in advance about the program, so uncertainty goes down rather than going up ahead of the program, and then it goes farther down on the day of the program, okay? Instead, for example, the announcement that is during the taper tantrum, there's no resolution of uncertainty, because you can see that both red and blue bar go up, meaning the uncertainty measure goes up before the meeting, and then it goes farther up on the day of the meeting, okay? So the investor got more confused after the FOMC announcement. So then the problem is that how to collapse the entire information in the term structure of uncertainty in one value, okay? So the way we do it for each announcement, we collapse the entire term structure of uncertainty in one value. And in particular, we are interested in understanding if the market uncertainty ahead of the FOMC meeting is unusually elevated relative to the previous year, right? Because we think this is a fair comparison, because uncertainty during the beginning of the crisis over that year is very different from uncertainty at the end of the crisis. So we want to normalize relative to previous year, okay? So then what do? We compute at each horizon the average uncertainty ahead of the FOMC meeting, okay, which are practically the red bar that you saw. Then we take a weighted sum of this average, and we use weights that are inversely proportional to the forecasting horizon. So we tend to give more importance to the more recent horizon and less importance to further away information. And then we normalize it by dividing it by the uncertainty over the previous year and subtracting 1. In this way, every number that you see in the table that is above 0 indicates higher uncertainty than usual, and the one that are negative means lower uncertainty than usual. And you already can see it under this normalization that is not the first SAP, the worst in terms of uncertainty. You can see that June 2013 is the worst in terms of uncertainty, and even September 2013, uncertainty was particularly elevated. Then what we do? We take the baseline, okay, and we interact this measure of uncertainty with the measure of balance sheet policy surprise. So now we're going to have 2 extra terms because each of the regressor is being interacted, okay? And in this case, we have pulled together all the events in one panel, okay? So what you can see, that beta 2 in the first row, okay, is still the average effect of a surprise across all events, and is about 2.3 basis points per 110 billion, okay? But if you look at beta 4, okay, which is the impact of uncertainty on the change in slope, okay, is negative and significant, suggesting that if the uncertainty is higher than usual, okay, the impact for 110 billion, instead of being 2.3 basis points, is going to be 7.8, right? Which is the sum of 2.3 plus 5.5, more or less, okay? So it seems that uncertainty tends to amplify the effect. So what are the main takeaways? Well, this poses some challenges to microfinance model because it doesn't seem that the impacts are dependent on liquidity or market friction, okay? And they don't wane as market friction are reduced, okay? And so it doesn't seem to be related to temporary market segmentation coming from limits to arbitrage. Okay. Instead, it seems that supply risk is more a systemic risk factor, that it gets amplified by the novelty of a program and uncertainty about balance sheet policy. Okay, just think about the fact that investors every time have to learn about the Fed managing multiple tools that are interconnected. So it's a very difficult forecasting exercise. And also we can see that I didn't have time to show it, but when we do the computation of each program, it seems that the supply effect are a large share of the total effect. And so it means that supply effects are sizable, okay? Then why does this matter, okay? So remember, what I'm measuring is only supply, so there's no signaling channel, there's no duration risk channel, okay? Ideally. So what happens? This means that when we control for expectation and uncertainty about balance sheet policy, then we find different results relative to the previous literature about the evolution of the effect, okay? This also suggests that if the sensitivity is not monotonically decreasing, right, but is the size of the surprise that is changing, then it means the forward guidance about balance sheet policy can be very, very important as the forward guidance about the federal funds rate, because it would tend to reduce uncertainty and give more information about the surprise, so would allow to control the size of the surprise better and would allow to better calibrate the impact of QE. So not only the size of the surprise, but also its persistence, okay? And this also means that since the effects don't wane down in normal times and away from the DLB, maybe it's not necessarily true the balance sheet policy should be limited to exceptional circumstances, right? Balance sheet policy should be part of the normal toolkit, okay? And finally, since supply effect relative to other channels can be more localized and they are sizable, that means that it is possible maybe through yield curve, through the supply channel, control particular segment of the yield curve, which means that in some sense, from an implementation point of view, this is information relevant for the yield curve control. That's all I have. Thank you. You're muted, Peter.
It was only compliments. I think it's a very important paper. I think it's, unfortunately, we ran out of time, but I think it's a very important paper. I still didn't get everything. It's quite impressive the way your strategy of looking at that. But you see, I thought, signaling would be part of what you explain now, signaling about the future balance sheet and all that. Because at some point you said the signaling, we don't take that into account, if I'm correct, no?
No, but
you have the duration effect, you have the signaling effect, you have the liquidity effects. Usually that's the three effects we have. Yeah. Duration, extraction, signaling. But the signaling I have in mind is signaling on future interest rates, while you probably look at a different signaling. I don't know.
No, that is the type of signaling. But what I'm saying is that, do you have a reason, okay, to believe the signaling would be different, to the impact of signaling would be different to the left and right of the kink? So do you think the signaling for a security that is 3.5 year versus a security that is 3.2 years would be different? I don't have any evidence. No. And I don't have any model that would motivate.
I understand.
So as long as the signaling effect is it doesn't affect differently maturity of very similar security, okay, yes, then I think that our identification is valid.
I understand.
If we have reason to believe, then...
Yeah, I get the point. No, I didn't understand it. No, I understand. No, that's a very important thing. Now you see, I haven't seen any question. Let me check. There is one question I see. Can you tell what type of uncertainty matters? Would it be smaller if policy was yield curve control, a la, Australian central bank?
So, We thought about this a lot when we were doing the review of the long-run framework at the Fed. And there is some evidence that yield curve control reduce uncertainty about interest rate much more than, for example, open-ended QE, right? Because you precisely know which maturity, so because you know precisely where the level of the yield should be and
absolutely, yes, yeah.
Only problem that is that what would happen towards the end of the yield curve control program, when there is this risk that investor might start, practically there is this problem that is called ballooning, right? So that they start moving ahead when they think that the yield curve control is going to end. And so then a central bank, to defend the yield curve control to the very end, will have to make the balance sheet size very, very large. And then in that case, toward the ends of the program, the uncertainty can be bigger. But that is towards the end of the program. But that is a very valid point. I do believe that yield control would reduce interest rate uncertainty more.
Yeah, I think yes. It's almost obvious, no, to say that. Yeah. Are there other questions? I think it's quite interesting. I mean, I don't want to prolong that, but when we think about the exit, from the exceptional measures now, basically, I mean, to put it in very simple communication, Stefania, what you say is that you have to prepare a market in time, should not surprise what in the ECB, because I made a speech where I signaled the market that we, probably will stop, QE by the end of 2000 and when was it, 18, I think. And markets didn't react at all. So it was a sort of taper without tantrum. It was announced. It would be progressive. It would be based, on better fundamentals and all that. And there was no reactions on market. And we're extremely surprised that it works so well, actually. Then, of course, the rest of the story is different because the economy went.
I think that
but I always think, why did it work so well, actually?
I think that the release of information well ahead and in a gradual manner is very important. And that's why I think the Federal Reserve under Yellen was very successful in doing the runoff of the balance sheet with minimal effect. And hopefully this is what they're aiming now in the next few months, because they keep repeating these things that they're going to provide information well ahead in a gradual manner.
Isn't it liquidity, Stefania? Isn't it related to liquidity that, balance sheets, of market participants will have to adjust, to that situation, and you need some time, or not at all? Because that would relate to market imperfections somewhere.
I think is also has to do, is in part liquidity, but is also in part something more fundamental, which goes to the persistence of the supply shock, okay? One thing is to know for how long the reduction in supply is going to last. Okay, so say for example, if from the very beginning, right, we knew that we would never sell MBS, right, at the very beginning. Why? Instead, in the background, there's always been a probability of selling MBS different from zero, right? So nobody ever thought that the shock in MBS was a permanent shock, meaning that this supply was gone forever. It was not going to come back to the market. That is going to have a very different impact than a more temporary asset supply shock, right? So forward guidance about balance sheet policy. Of course, this paper is not about that because it's
fantastic. No, that's. I'm sorry to interrupt you because it's really, the ECB is going to stop sometime its PEP, program, pandemic emergency program. There's a huge amount of money, of course, and 1.8, something trillion of euros. And this is supposed to be reinvested until at least end of 23. That's the communication today. While the other portfolio, the other QE portfolio is state contingent. So it's going to be reinvested, etc. for an extremely long period of time, this market expectation. So there are two portfolios there. And I'm very worried personally about the PEP portfolio, because there's a big uncertainty about, you know, a very big amount of money. And I personally think that, it's, the more you get, out of the pandemic, the more this is a big risk in them. And this is not very much discussed about the reinvestment portfolio. And I think this is a risk for the ECB now. Now we have a little bit time, I think, but it's what your research, I mean, is extremely interesting, I think, and would be nice to do it a little bit, analyzing a little bit the ECB also. It would be quite a nice paper and useful.
Yeah,
and very
every
useful.
time I see ECB papers, like I'm so impressed because their analysis is much more complicated than US QE. Like they have to take into account so many more things that we have to take into account.
And, it is. Yeah. Oh yes.
It's always very
because,
impressive to
me.
me.
The country composition and all this, there are plenty of dimensions. But the basic thing, I mean, which is not discussed, at least publicly, is what do you do with this big portfolio where the deadline, you see, that means the end of the pandemic is coming closer. And that portfolio is supposed to be reinvested until a date which is not very far away, end of 23, or more if needed, of course. There is an escape. I think that's a big uncertainty in the market. And I see what you are telling us as something that has to be tackled,
Yeah, and they also had a very good paper that have been tackling like the importance of the persistence of the shock. For example, Greenwood, Anson, and Vallanos, and Lee and Wei, and they also talk about the persistence. This paper that does not have that feature, but that is very important.
I fear we have to stop. I check again if there are other questions. I don't see. No, I don't see. So thank you very much, all of you. I think that was a fascinating session. And take care. Many thanks. Bye-bye.
Thank you. Bye.
I see Stefano also.
Thank you so much. Bye, everybody.
Thank you.
Bye-bye.
Yes.
Bye-bye.
Bye.
Bye-bye. Yeah. Yvan.
Yeah, goodbye.